You're about to join Jerry Parker, Moritz Siebert, and Niels Kostrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Welcome back to this week's edition of the Systematic Investor Series with Richard Brennan and I, Niels Kostrup-Larsen, where each week we take the pulse of the global market through the lens of a rules-based investor. For those of you who are regular listeners, our conversations are intended to give you as much of the nurture and encouragement as the turtles got back in the 1980s, as Jerry likes to put it. And if you're new to the show, we hope that today's episode will trigger your appetite to learn more by diving into the back catalog and listen to all of the past episodes that you may have missed. Like last week's episode, which was also with Richard, where we shared our thoughts on pyramiding and defining non-linearity when discussing trend-following models. Rich, great to be back with you this week as well. How are things going down under?
Yeah, very good, Niels. As I mentioned last week, in Queensland here, we've been very lucky in managing this COVID Delta virus, but some of the other states around Australia haven't been so fortunate. So New South Wales, they had a policy of not attacking the virus as soon as it sort of entered their state. And due to that sort of lag that they had in their attacking that virus, it spread very, very quickly throughout New South Wales. And so there's this border blocking New South Wales and Queensland, which is being highly sort of surveilled at the moment. And I suppose it's only a matter of time before Delta gets into our state. But with this suppression that we've had, we've been fortunate enough to allow our economy to tick over quite nicely. And with some of the other states that also have zero cases, we've been able to get a fair bit of domestic interstate travel going to help some of the tourism operators and things like that. But of course, international tourism operators are having a very hard time, and anyone that relies on this sort of international trade. But it's very interesting looking at the way the different states are managing all of this. It's a bit of a jigsaw over here in Australia. And so we've got these the warlords of the states at the moment all doing their own thing. And, I think the people in general are voting with their feet, saying we like that they're looking after us sort of. So we'll see how it fares.
Yeah, without a doubt, COVID has certainly been handled differently between various countries in Europe as well. I noticed that yesterday, actually, my birth country of Denmark announced that all COVID restrictions will be removed completely on the 10th of September. So now they're declaring essentially that it is now kind of just in quotation, a normal disease. So that is, of course, good news if you live up in the Nordic countries. Now, before I go on and talk a little bit about this week in review, let me just, as always, acknowledge those of you who took time and left a rating and review this week. We so appreciate this. They really do help. And I can only encourage every one of you who have not yet left a rating and review on iTunes to maybe spend 5-10 minutes of your time to help us out. Now, this week ended with an quote-unquote everything rally, a risk-on day, as the financial media likes to call it, where nearly all asset prices closed the session higher. Stock prices, bond prices, commodity indices, grain, soft, precious metals, forex, Bitcoin, base metals, and the entire energy complex, they all rallied yesterday, Friday. Most likely, this was a result of Jerome Powell's turning ever so mildly dovish in his comments at the virtual Jackson Hole Central Bank meeting on Friday. But despite a number of the US bankers calling for an immediate halt to the open market purchases, the chairman said that open market committee is likely to commence tapering before the end of 2021. It seems like the markets had set themselves up for a more hawkish kind of language, with some looking for an announcement that taper would begin as soon as September. Now, while the Fed doesn't always look to the calendar in making policy announcements, the chairman may have realized that doing so on a Friday or the last Friday in August could rock the markets, but instead the treasuries traded pretty quietly sideways, which was enough to drive the S&P and other equity indices to another record high. With the news wires busy with the mess in Afghanistan, President Biden's stimulus package, and of course COVID, the general public seems to have forgotten that the US is facing yet another debt ceiling, and that is expected to arrive in the coming weeks. Negotiations, at least how I remember them, about raising the debt ceiling can become quite intense, so perhaps this is something to pay attention to. Now, next week, the US August employment report is out on Friday, and that is the day before a US 3-day weekend. But if you're active in the US markets, as many of us are, note that Friday will be a full trading day, and it could turn out to be a volatile one depending on the report itself. Let me just bring you in, Rich, again, and just touch maybe on some of the things. It's only been a week this time since you were on last, so maybe you haven't noticed too many new things. But of course, I don't know if there's anything that caught your attention this week.
No, look, it's been one of these up, down, up, down, up, down, up, down sessions. It's very much like the kangaroo song over here with my portfolio over the last month or so. But the Aussie dollar that was doing well last week has come off a bit. My energies are doing very nicely, especially natural gas, but crude and Brent are also doing nicely. The indices are sort of creeping ahead, still, but going higher and higher and higher. When that will end, no one knows. But that's about it for my portfolio. The rest is just this up, down, up, down, up, down story.
Fair enough. On our side, actually, from where we sit, the markets returned, I should say, to kind of their longer-term trends this week. And that's certainly something that we benefited on in our trend-following strategies. And in many respects, it was kind of reverse of the week before. The best sectors this week was energies and equities, where we saw some positive contributions from pretty much all the markets in those sectors. Softs and grains also added a bit of performance this week, as did volatility and currencies. The only sector that had a small negative contribution on our side was really the fixed income markets. And actually, specifically, it came from the short-dated Australian bonds, Rich. So you need to sharpen up there. Anyways, metals were pretty flat this week for us. In terms of volatility, the quote-unquote well-anticipated virtual central bank meeting this week certainly has kept the VIX elevated at the beginning of the week, but the rather dovish comment from Mr. Powell sent the VIX lower on Friday, was down 2.25 point for the week. As a result, the realized volatility in the S&P flirted with historic lows around 8.5% annualized. Compare that to the average VIX index level of 17.53 during August. The VIX also remains highly sensitive to declines in the S&P 500. We've talked about this before. And again, this week we saw on Thursday that there was this tiny 0.6% decline in the S&P from peak to trough, and that caused a 2.5 point rally in the VIX. So a lot of reaction still as soon as the S&P shows a little bit of weakness. But all in all, this was a slightly positive week for our volatility strategy. In terms of the trend-following portfolio, my own trend-following portfolio, it was a small up week, I would say. It's still down 1.43% for the month of August, and it's up 10.32% year to date. Performance so far this month, as we come to a close pretty soon, Group 1, flat, I would say, up 11 basis points. Group 2, doing okay, up 79 basis points this month. And Group 3, the fast reacting, that's really where the pain is coming in, down 2.34% this month. So not faring too well with some of this up-down moves that Rich just mentioned. Sector performance, the top 3 sectors are still only top 2 because there's only 2 of the sectors that are profitable, equities and softs. And the worst sectors this month, bonds, base metals, and currencies. Bonds, I imagine, actually is from the shorter-term models, by the way. And if we drill down to single markets for the month, the SMI, the Swiss Market Index, and the Nasdaq and the Australian SPY, so all equities, make up the top 3. And at the bottom this month, we see the DAX, copper, and 10-year notes. In terms of the trading this week, pretty light. Monday, the program bought a bit more of NASDAQ. And that was the only thing it did. Tuesday, it bought a little bit of live cattle. And that was the only thing it did on that day. And then Wednesday, one of the short-term models took a very nice profit, I should say, in a long German Bund trade, and then tried to go short. And that was it for the week. Thursday, Friday, there were no fills for people who follow the risk to stop, which, by the way, is in one of the questions today. The risk to stop level, meaning if all the positions got stopped out on Monday, the model would lose 12.5%. And that is a little bit up from the 11.35% last week, but nothing too dramatic. Now, Rich, before we jump into, we have some great topics, by the way, at least in my opinion. We have some good questions that came in, but also you brought along, again, some great topics to discuss. But before we jump into the questions today, I just wanted to touch on last week's topic where we talked about trend followers being hunters of outliers. And I was thinking to myself this morning that perhaps we came across last week as if trend followers were the only people doing this, but that's really not the case. I would argue that this is precisely what venture capital funds do, and also what normal equity index investors do, because if we look at what has driven all of these equity markets to new all-time highs, it's really just a handful of stocks like the FANG stocks. So perhaps we are more similar to other type of investment strategies than most people think, and we just talk about it differently, so to speak. What are your thoughts on that?
Yes, look, I believe that a lot of these other methods are beneficiaries of these outliers, but what I'd say is that we specifically target them with our asymmetric models. So buy and hold, of course, are the beneficiary of these outliers, but they also don't have any tail risk protection in their models. So what they might achieve on the upside, they lose on the downside when this non-linearity gets unfavourable or favourable. But our method is strictly getting this benefit of non-linearity from positive returns, and our models strictly mitigate any adverse downside risk. But there are other divergent models that are specifically attacking these outliers as well, such as option strategies, etc. So yes, I'd say in this bucket of styles called divergence, yes, this is principally where they're getting their benefit from, these outlier moves, non-linear moves. And I just say that we have a very efficient technique of extracting that edge that exists within that outlier.
Yeah, exactly. So my conclusion and the notes I wrote down is that so the key difference is not how we look to make money, but rather how we manage the risk, avoid the 50% drawdown as equity markets will have from time to time, because we obsess with cutting our losses, which ties in quite greatly, I would say, with the fact that trend followers look at themselves as risk managers first and foremost, because we can control the risk we take, and then we just have to let the profits take care of themselves. All right, let's jump into some of these questions for this week. The first one coming from Louis. Louis writes, "Hi Niels, thanks for the amazing podcast. I've been an avid listener to your show for some time. Also a huge shout out to Rich and Fred for the invaluable educational content they provide at ATS. They've taught me everything I know about trend following, and they are always on hand to offer support, so thanks for that. I've constructed and have been forward testing my trend following portfolio across currencies, equities, metals, energies, and commodities for some time. The question I have is pretty general, but I believe I'm ready to transition to a live account. Based on your combined experience, are there any nuggets of advice or any lessons learned you could share in this regard? I anticipate that my portfolio will go into a drawdown and could be in the red for some time whilst my models sync to the market. Do you think it would be a good idea to lower the portfolio leverage to allow for this initial incubation period whilst the portfolio gets up and running? My plan is to trade a small account so that I can gain exposure to live trading with the intention of scaling up on capital. Thanks a lot, Louis. So, Rich, I'm going to let you jump in first.
Yes, look, it's great to hear from Louis. He is one of our very active members of our site. And he's a lawyer by background. And I have this theory that lawyers make good trend traders. And he's certainly demonstrating that. He's taken the bit by the teeth in what we're delivering to him. And it keeps Fred and I on our toes, as we've always got to try and keep ahead of them. There's a couple of very cluey guys in our forum who make sure that we keep the research coming, keep them abreast of new ideas. But what Louis speaks about is this inevitable entry into the market with your live account once you've done all of your research and testing. So he's already done extensive research and development through his backtesting phase, and he's also done a significant incubation phase on using a virtual private server with all of the algorithms basically in a what they call a demo environment setting to ensure that all of the algorithms are free of any execution issues. He's also been doing what we call parallel testing, which is whereby you compare and contrast your backtest results against your live trade results in that demo environment. So there needs to be some degree of synchronicity between the two. The only difference being that there might be a bit of cost variability between your backtest and your demo. But now, after this incubation phase has been completed, he's now ready to launch his live account. And from our experience, what we've found is with these particular trend-following models that we adopt, it often takes around about a year or even 2 years to get traction, dependent on the nature of the market when you enter the markets. And, when we go back in time to the 1980s or the 1970s, where trends were ubiquitous, you tended to sort of, when you took a start in this market, you immediately became the beneficiaries of some of these trending conditions. But in these more difficult regimes these days, you can, for instance, start your trend following program and find that it takes a year or two before you can ever catch any of these possible outliers. And all of that time you're spinning your wheels and you're getting drawdowns, you're getting depressed, you're thinking, gosh, all of this work I've done, is this going to eventuate into something? I hope I haven't made the biggest mistake of my life believing these guys have told me that this is what you need to do. So what I'd suggest to Louis is start small. Start with maybe half his trade risk that he was applying in his backtest, simply to get comfortable with the volatility that he's going to achieve in that first few years. Because, as I said, with these long-term models, initially, all the trades that you get, the closed trades, are going to be losses because some of our holds in our backtest show that we're holding for 2-3 years, etc. So to really get the beneficial sort of impacts of those long holding trades, you need to have about 2 years under your belt before you see that translating into your realized balance of your equity curve. Of course, you've got your unrealized balance, but it inevitably starts out going downhill. And so therefore I'd suggest, well, avoid the pain that's typically faced by a new entrant in where they go down fast because they're applying what they applied in their back test. I'd say halve it, get to feel the volatility in it until you're comfortable with it. Once you're comfortable with it, then lift it up to maybe your back test level. That's what I'd be suggesting.
Yeah, I mean, it makes a lot of sense. A couple of other ways to maybe look at this, Louis, and I don't know what the system is, so pardon me if what I'm going to say now doesn't make sense or doesn't really apply to the way you've set your system up. But I mean, a couple of things that I would also do is perhaps just like I do on with my system every day is just to look at what is the open risk, so to speak. If everything got stopped out of current positions, are you at a peak level there? Then maybe that's another reason why you would start smaller. Another thing that, of course, you hear Jerry and Moritz talk about is that, look at the sort of close profits. If you are looking at your most recent back test or live test of your system, how much open profit do you have? So just be aware of that. But in general, I mean, we can come here with all our theoretical ideas. The whole point is, you need to get started. And as Rich says, why don't you just start with half and scale it up? I think that's as good advice as any other advice we could give you. And also, I think sometimes we need to be careful not to overthink what we're doing. I mean, that's the whole point about having a system and having rules is we try not to think too much on a day-to-day basis once we're in it. So good luck with that. Louis, let us know how it goes. Question from Aaron. Hello, long-time binger of the podcast. First time I'm writing in. Thanks for the work you do. I can think of no better resource which offers the perfect blend of trend-following wisdom and smooth jazz interludes. I appreciate that, Aaron. And my question, Niels, I've heard you cite some research to suggest that an extremely high number of investment portfolios can improve their risk-reward profile by allocating some of their capital to trend following. I want to flip the script. If you had to, were forced to allocate 20% of your capital to a non-trend following, non-momentum strategy to complement your main strategy as a trend follower, which strategy would you choose and why? Interesting question, Aaron from Utah. Rich, let me flip it to you first.
Yes, Aaron's flipping the tables on us, and I'm not sure I'm very happy with this, but we've now got to put the boot in the other foot. So he's saying, where do we allocate 20% of our balance to, recognizing that 80% is in these trend-following models? Now, I have a feeling he's forcing us into this convergent world, Niels, but if he's not, I'd be putting my 20% into these option models that we were discussing with Derek Wong the other day. I'm a strong believer in divergence, and I think you get these absolute returns from divergence. And with finite capital, when you've got to make a decision, do you go divergence or do you play with a bit of convergence? I tend to think, well, you're sort of suboptimally playing with convergence if you incorporate them into your models, because that capital could have been better spent in divergence. But look, if we can't play with divergence and we've got this 20%, I'd actually use a process to make my decision. I wouldn't make my decision on my gut feel or intuition. I'd use a bit of empirical testing. I would be looking at very long-term data sets of models, different models, as opposed to trend-following momentum models, over a similar time frame, like 20 or 30 years. And then I'd be assessing the rigor and robustness of those models. I wouldn't actually be saying which is best or having any sort of decision-based or discretionary decision-based logic applied here. I'd be letting the data tell me which are the most robust, which offer the greatest compiled benefit with my 80% of other portfolios. So there I'd be sort of incorporating different return streams of these 20% of different models into my portfolio comprising 80% of my trend-following models. And there'd be some sweet spot I'd get from the iteration of all of these different return streams together to create this best risk-adjusted path. I'd be looking at that over a 30-year period. So that I'd be using a process, a data-driven process to empirically test, as opposed to a statement that, oh, I like a carry trade, or, oh, I like value investing, or, oh, I like mean reverting. I'd be making sure there's this empirical validity to it, if that makes sense.
Yeah, it does make sense, and in many respects, you could say that that's probably would be a safe answer for me as well. You could say it slightly differently. You could say, well, Aaron, maybe you want to just find a strategy or an investment that generally has a very low or no correlation to trend following. If you got 80% in trend following, by the way, I really like the fact that you say it's the 80% that goes to trend following and not the 20% as we normally do. So that's great. But I could also give you another answer, Aaron, and that is to say, okay, if I'm investing in a diversified trend-following portfolio with most of my capital, I'm very diversified, I'm playing it long and short. So what else, what kind of crazy kind of thing could I do with the 20% that might actually be serving some kind of other purpose for my long-term wealth creation? So I could also say, well, maybe you want to put 10% in gold and 10% in Bitcoin for that matter, just to do something completely different to what you would do if you start thinking too much about it and finding something that's non-correlated. Or you could even put some of it in long equities for that matter, because we know of the long-term correlation between equities and trend following. So I'm kind of maybe more open-minded about what you could do, but I think that, a little bit of research into what would fit trend following well is probably a good idea. But on the other hand, if I was thinking about just wealth protection in the long run, then I might actually think really differently than just finding another strategy. I might think about what kind of asset would I like to own if the whole world go pear-shaped, so to speak. But anyways, interesting question. Never had that one before, so I appreciate that, Aaron. Now, the final question is from also down under. I think we could safely say it's from New Zealand. It's from Graham. Even though I have to say, Graham, the way you spell your name threw me off a little bit. Maybe it's my dyslexia, but luckily I had Rich on hand to tell me that actually it's pronounced Graham. Hi, Niels. Do you enjoy your talks with Richard down under style? I'm in New Zealand. I trade a systematic model around 2 instruments, only the Aussie SPY and crude oil. Can you talk a little bit about margin per trade instrument, perhaps excluding currencies? Nice to say you trade 50 instruments, but I doubt they all have the same margin, and how you allocate the money. I guess that means margin. One other small point, I think your short-term model, you quote, if they all get stopped out tomorrow, off the top of my head, is 10 to 13%. So that's the risk to stop, by the way, just to clarify that. Seems to me quite good/low, any elaboration. I personally like $10,000 per trade to be on the safe side, maybe SPY and crude oil, bigger contracts, ? Thanks very much, from Graham. Rich, any thoughts?
Look, it's good to hear from our brother from across the ditch, as we say. So that's the Tasman, and he's over in New Zealand. So he's a Kiwi. So we love our Kiwis, except when we're playing rugby and cricket. But we're partners in crime. But to Graham's question, so just to give a context for margin, when we're trading leverage products such as derivatives, such as futures, CFDs fit into that, and there's other derivative products as well. They're leverage products. When you put your money into a broker's trading account, a portion of that money is assigned by that broker to a margin, which is a degree of collateral that is required, or a deposit that's required, that takes the risk associated with the current active trades that they've got in their broker's account. So based on the account balance that you have in your broker's account, this margin is being continuously calculated on an ongoing basis by your broker, and it goes up and down dependent on what your current equity is and what your trade activity is, and what the unrealized profits or losses that exist in that equity. So what this does is, this is simply something that is used by brokers to give them a degree of asset protection. And because we are getting the benefit of leverage products or credit products, where we're only supplying a portion or a fraction of the value of that underlying instrument. And hence, that's why we get the leverage, which is necessary, particularly with our diversified trend following models. Fortunately for us, margin, because we can trade on margin, that allows us to spread our capital very widely across very many different return streams, as opposed to simply having no leverage or no margin and investing directly in an asset like shares. And if we had, say, $100,000 in shares that were unleveraged, I could only buy, say 10 of them at $10,000 each to totally utilize my capital balance of $100,000. But with leverage, I can achieve exposure of maybe 200 return streams, especially in my world of CFDs and Forex, which Forex is another derivative instrument. And that allows me to achieve very wide diversification through this leverage. But I don't actually use margin or leverage as a basis to allocate money or to my particular return streams or to my particular strategies. I'm using a fixed dollar risk assigned to each of my individual strategies or markets after they've been normalized. So I use the average true range, or the ATR, as a basis to normalize the volatility of my markets. And therefore, I then can apply a standard fixed dollar risk, or an equal bet size in dollar terms, to each of the markets I trade, which is not using margin or leverage. That's using a volatility measure, ATR, a normalized volatility measure, to risk a certain defined amount of capital in relation to my account balance. So No, I don't use margin as a basis for a form of allocation. That is an unfortunate requirement for us to put up our capital to our brokers. And in the event that our account balance actually drops below this margin calculation that they're calculating, that's where you get this dreaded word called the margin call. Now, we all want to avoid the margin call, because what happens with a margin call is that's a broker saying, well, the current calculation of that margin is greater than your current account balance you've got with us. You now need to top up your account balance to exceed that threshold. Otherwise, if you don't give that money to us in the next 24 hours, we're going to sell those positions under you that are causing that margin. So if that's the case, then you can get into a horrible world if you get to these margin tolerance thresholds where suddenly your models, all of the back testing, you don't see this in the back testing, the margin call totally makes all of that work useless. So you therefore want to keep away from those margin thresholds. So you don't want to over leverage your portfolios or models. But as I said, I use an ATR-based method to allocate a fixed risk or a small bet to each position. But then I do keep an eye on my margin to make sure that I'm never in a situation where my account balance gets close to that margin threshold. And fortunately, with our particular trend-following models, the cut losses short, let profits run, have a very small bet size. Unless we are applying excessive leverage in our portfolios, we find that we keep very clear of those margin threshold levels to never be in a situation for a margin call.
Yeah. So maybe just to add a few things. So it's absolutely right what Rich is saying, Graham, in terms of when you say how we allocate the money, so to speak, it has nothing to do with the margin. I think, though, when you decide on your portfolio, obviously you're trading two instruments, so it's relatively easy to find out. But if you were to include more instruments, it's very, very easy to find out what the margin requirements are for all of these futures markets. But it shouldn't be the one that's kind of guiding you, maybe with the exception of if there's a contract that just has such a large margin requirement, you might want to skip that. The one market I can think of that is in that category for many investors in the diversified portfolio is something like Palladium. Palladium, for some reason, has a massive margin requirement per contract. So yeah, just like Rich explained, the risk is really just allocated of how much money we're prepared to lose on a single trade. And then you asked about this risk to stop level that I quote every week, and which you're right. I mean, I think on average it's often around 10 to 13%, but it can certainly go somewhat higher. From memory, I've seen it around 20% at times if you have lots of. This normally would happen when there are lots of open profits. So you have many positions, you have many trends. The markets are moving in your favor, so your stops are coming up somewhat slower, and therefore the gap down to the stops can give you this risk to stop at a higher level. Is it low? Is it good? I don't know. I think that's a personal decision. For me, it's fine, because if I look at the overall returns of this model over time, it's pretty attractive. I can't remember from on top of my head, but it's probably kind of a 15% type strategy net of fees in the long run, which is, I think, for a trend following strategy, pretty good. But also, despite that, and despite the number being low, it doesn't mean that your losses will be capped at 10 to 13%. Your drawdown can be a few times that when you see it over time, because drawdowns can, of course, happen when you have multiple entries that get stopped out over a period of time. So my particular strategy certainly have seen drawdowns since 1990, where the data goes back, of around 38% from memory is what it is. And that's not unusual that you have maybe a 1 to 2 or 1 to 3 risk reward relationship, meaning if you can make 15% on average after fees, you probably can lose 40% in a given drawdown. That's typically quite normal. I mean, just as a reminder, equities we say are around 7-8% long-term returns, but we know the drawdowns are more than 50%. So it's still a significantly better risk-reward ratio, in my opinion, than equities, for all the reasons we talk about every week on the podcast. Let's leave the questions here. We appreciate all of you for sending them in, and keep sending them in because it makes the show more fun for you, the listener, I'm sure, and it makes it also fun for us. And it also is quite educational for us to find out where's the interest in terms of the trend following journey that you're all on. What are you finding difficult? What do you want us to weigh in on? So we really appreciate every week receiving 3, 4, 5 questions from our community. Now, this is part of the show where we again go into some of the topics that Rich brought along. And today we're going to first tackle, I think, a big one that we have had so many questions about in the past, and which is kind of a really tricky area, but nevertheless hugely important to not just get it right, but certainly make sure and understand how to avoid getting it wrong. And that's backtesting. So I think I'm going to just let Rich set the scene, talk about some of the things that he had prepared, and then I'm going to jump in with some observations or thoughts or questions to that, Rich. So if that's okay with you, why don't you talk about backtesting?
Okay, Neil. So I recently wrote an article called "The Good, the Bad, and the Ugly of Backtesting," and it had Clint Eastwood, Lee Van Cleef, and I think it was Eli Wallach, doing the face-off together. And there certainly is a good, a bad, and an ugly part of backtesting. And I just like to explain this. So with trend following, we've discussed on prior podcasts together how our primary goal is to capture these outliers. And we've already stated that outliers are non-predictive in nature, and they're the secret to our success. So in relation to someone saying, well, then why do you use backtesting if you can't, if you don't have any predictive ability about the nature of these outliers? And that's a very good question. Why do we use backtesting? And I know a lot of trend followers are not very fussed with backtests as any form of measure. But what I would say is this. I'd say that we need to drop the notion that backtests are a method to predict expected returns in the future, as we certainly cannot predict them in any shape, way, or form. So immediately that eliminates the backtest, which is traditionally used for a lot of these predictive models. We can't use it for that. But there are certain things that we can use it for, and we always talk about strong adherence to risk management. And backtests are something that are very useful in managing risk because they give us a roadmap or a blueprint about how to manage risk. So in relation to the bad, well, the bad is we cannot use backtests to forecast expected future returns. If we believe that our backtest has any resemblance of what's going to happen in the future, we've got rocks in our heads and immediately dispatch that viewpoint as a silly idea from a trend follower who has no knowledge of what the future will bring in relation to outliers. The ugly is when people use backtests as a way to get these lovely linear equity curves, where they adopt these beautiful ascending equity curves that are very smooth in nature, but it's only focusing on a specific narrow market regime. But because they've spent all of their effort in developing this beautiful straight equity curve, they believe that that beautiful straight equity curve has some enduring feature into the future. But as we know, when you curve fit your backtest to a specific market regime, and that regime then changes, that linear, beautiful equity curve suddenly nosedives and it goes quickly towards possible risk of ruin. Now, that is the ugly part of the backtest. The good part of the backtest is that it can be used as a way to assess the assumptions of risk management that we adopt into our models. And a further use of the backtest is it allows us to distinguish between what we regard as outliers versus alternative trends that exist in noisy and mean reverting environments. So just to break that down, so let's say we have assumptions in our backtest model that says, where do we place our initial stop? Where do we place our trailing stop? We have them as a design consideration in our models, but the actual placement of them, how far away, how many ATR away they need to be, needs to be undertaken throughout a backtest to evaluate the level of noise that exists and where to optimally place these so we don't get this perpetual whipsaw from having our stops and initial stops too close to our entries. So we need breathing room, and a backtest is a way to, from an empirical way, to assess the level of noise in markets or the average range of markets to identify where to place these things. So that's useful for a backtest. A backtest is also useful to ensure that we've got positive skew in our models, because we can actually use a backtest to then evaluate how our models have been applied to historic market data. And then we can identify whether there is positive skew in the signature. In other words, does it catch the outliers that we want to catch? And how good is it at avoiding noise and mean reversion? So that's the risk mitigation methods that are very important with backtesting. And another very useful element of the backtest is in relation to it. It allows us to estimate what is the appropriate leverage to apply in our models. Now, without a backtest and without a knowledge of how it's performed over a historical data set, it might be too easy to be too aggressive in our leverage on our models. Too much position size. How much position size? How little position size? What is regarded as excessive leverage that creates these very volatile equity curves? We don't want that. So a backtest is a very good way of basically gauging the level of leverage that we need in our models to get a good result over the long term without too much volatility in our equity curve. And another very useful element of backtest for the risk management side of it is that it allows us to incorporate real trading costs into our models to evaluate, well, what is the material impact of trading costs, such as the spread, the holding costs or the swap, and any slippage that might occur with our breakout entry or our other forms of trend following model. So by incorporating these more realistic costs into our backtest, we can look at what is that degree of materiality of the costs, and is that too much, too little? How much edge are we getting from our outliers in relation to the negative drag associated with that cost? That's something backtests can always give you. So that's a very good part of backtests. But importantly, in relation to risk management, backtests are a way to stress test our models to ensure that whatever history is thrown at us in the past, now this does not need to be the history of actual history for a particular market. We can create new histories through reconstructing data through random modeling, where we insert serial correlation into that modeling to create new data we've never seen before, historic data we've seen before. We can normalize backtests across any different markets. So rather than seeing things as different markets, all we are seeing is different possible historic data sets that we can apply our same trend following models to. That therefore allows us to rigorously stress test our models, just like a bank stress tests their models, their banking models. We can do the same under the backtest. So that's the risk mitigation part of the backtest, which is very important to us and is very useful. That's one of the half of the good. The other half of the good is it allows us to distinguish between an outlier versus a trend. So just to explain that, there are three possible classes of trend. We can have a random trend, which is constructed from random data. We've explained this before in a previous podcast with you, Niels, but it's very easy to construct random trends from the data that is independent in nature. Each of the price points is independent to each other, but it still can create a random trend. Or if these trends are serial correlated, so if we have serial correlation in the data, we can create a trend which is a small component of a bigger mean reverting cycle. So the noisy trend or the random trend or the mean reverting trend are actually trends we don't want to catch. A trend that is a small component of a larger mean reverting cycle results in this whipsaw or this fake breakout. So when we're expecting price to continue on, we have our breakout models, we jump into the trade, and immediately it whipsaws back quite significantly with momentum. That's not a noisy trend, or it could be, but more likely it is a mean reverting element that looks like a trend, but it's only a small segment of a bigger mean reverting cycle. So those two forms of trend we want to avoid. The third form of trend that we want is this outlier. We've already explained that. It's nonlinear in nature. It's got serial correlation in the series. So if we've got these three different possible types of trend in normal, everyday, average data, how do we delineate between an outlier and these other two forms of trend? And that's where we need to look at what we call the Gaussian envelope, or the envelope within which all three types of trend exist, and then exclude the two forms of trend that only reside in the normal distribution component of that Gaussian envelope. Anything outside in the tails of that distribution are the outliers we want to get. So that therefore allows our backtest to actually define these zones within which price becomes more elastic in nature. It steps outside the normal range of the market. Price gets more elastic in nature. We get these volatility surges. We get non-linearity coming into our trends. Serial correlation, because of positive feedback, is drive or accelerating these trends away. That is something that occurs within a phase shift context between the normal market regime, where everything is sticky and we get this linearity, to when price gets more elastic and moves into this sort of volatility expansion phase, where we get this convexity, we get this acceleration out of that particular phase of the market. That is something that backtests also can define. So whilst we can't predict these outliers in advance, we can certainly eliminate the negative trending impacts or the negative impacts of noise and mean reversion on those outliers through our backtest. So that's the second half of the good phase of the good, the bad, and the ugly of backtest. So that's what that article was about, Niels.
Okay, so let me share some of my thoughts, but also maybe quote unquote push back a little bit on some of these things, because I hear this all the time, right? That, we can't really use the backtest to very much in terms of what the future might look like. Everybody will say that. They'll also say that there's never been a bad backtest, which of course is true, because people tend to end up fitting and so on and so forth. But here's the thing, and this is maybe not very well phrased, but what I hear you say is, and you're not alone, by the way, on these things, is that we can use some of the backtest for things such as to look at the riskiness, to see certain things. But I'm just thinking, well, if we can use that part of the backtest, why can't we use other parts of the backtest? How do we distinguish between what we can use from the backtest and what we can't use from the backtest? To me, that is not logical. So I look at it slightly differently, meaning I think if I look at a backtest, and we can come to about how maybe one should do a backtest, we can talk about that. But if I look at a backtest, do I expect exactly the same returns and drawdowns? No. Do I expect something? And by the way, I should emphasize that when I think about a backtest of a strategy, I think about a backtest that has been over such a long period of time that you've gone through many different types of environments. I'm not looking at 6 months data or 6 years of data. For trend following, it's probably 30 years of data, maybe not more than that, because then some of the markets weren't even active by before the 1990s or 1980s. But a very long period of time where you could argue that we've had certain different regimes, we've had lots of surprises, black swans, and what have you. So if the backtest seems to first of all, it has to look, when you use just your common sense, it has to look that it's reacted in a logical fashion. From a trend following point of view, it should probably lose money when trend following indices are losing money. It should probably make money when everyone else is making money. The point of the backtest for a trend following product, I think, is to see whether possibly you found something where you make a little bit more money than other people, or maybe you lose a little bit less than other people, and therefore, quote unquote, you have a system that is maybe a little bit better than than what other people have. So I think so to me that's really important. So I actually think that, okay, I'm not necessarily expecting the same results year by year, but I'm certainly expecting the same profile, meaning I want to see, or I will expect that drawdowns, okay, they could, of course, be worse than what you've seen in your backtest. We always say that your worst drawdown is ahead of you. So you should be prepared for that. But you should also take some level of comfort, I think, in what kind of drawdowns you've seen in the past, both in depth, but also in duration. Now, of course, we've just gone through a period of time for trend followers, which has been unusual, where probably drawdowns have been longer than they were for a very long time. And I can't remember exactly when, but not that long ago, within the last 10 years or so, I seem to remember that many trend followers, this could be around 2013-ish, summer of 2013, where trend followers who had been around for 20, 30 years actually saw their worst drawdown ever in their track records, and actually by quite a big margin. So about 50% deeper than what we had seen before. Not everyone, but many of the leading CTAs did. So let's be absolutely clear that whatever you see in your backtest is not a guarantee that it can't get worse in the future. Of course it can, but at least you should be somewhat aligned with what other managers see at the same time. So for me, the profile is very important when I see the backtest. And what I really like to do myself is, and in some ways, that's what I've been doing with my own trend following models, because I work for a firm, so I don't trade my model live. That I can't do that. But it's given me like a 7-8 year forward test. Every single day I run the model. I see the performance. I can compare that to the live data that I have from before joining Done. And I can compare that to the backtest of the model from before we got it live, but what we based our assumptions on to implement the model originally. And of course, people would never say, okay, yeah, I'm going to spend 10 years just doing a forward test and to see if I'm right. I understand that. But it's been very, very interesting to see, because I guess it tells you something about how good you were at doing your backtest in the first place. What are the assumptions you used? Because you said that we want to avoid curve fitting, but I think we actually do want some level of curve fitting. That's how we get to what we're looking for, but we don't want overfitting. So to me, there's a big distinction between curve fitting and overfitting, and so on and so forth. So maybe what we could do, Rich, is maybe we could share a couple of thoughts, and I would love to hear your thoughts on how do you make a backtest as objective as possible? How do you make it as robust as possible so that you can take as much comfort from it as possible, but still with the caveat that things can change? We know that, so that some of these things will turn out differently in the future. But at least then it should probably be aligned with what you're seeing in the industry as a whole. Meaning, if you're a trend follower, you shouldn't be making a lot of money in a year like 2018, because the whole industry lost a bunch of money that year, and vice versa. Do you have some thoughts about how to make a backtest as objective? Do you have a checklist you follow? Do you have a process? I think with everything we do in trend following, it's all about building a process. And I think when it comes to backtesting, I think it's the same thing. You kind of have your own little checklist of the way, what you want to do, in which order you want to do it, and you know what kind of checks and balances you have along the way.
Yes. So look, one of the we've got quite a few processes we're involved, but an important one is what we call mapping to market. And this is where, once we've done a backtest and we generate an equity curve, what we do is we explicitly map that equity curve against the market data. So what we're trying to see there is that there is this inevitable ability within data mining circles to over-curve fit your results, which is effectively to some part of the signal that might exist, but also possibly to a lot of the noise that exists in that historic market data. So if we get an equity curve that's starting to appear linear, we automatically get suspect, because that is not an equity curve that can be generated with a trend following model. Because if you could imagine where trends exist in the market data, they are not continuous throughout that market data. There are long periods of drawdown or stagnation of random market data, and then we might get a trend arising. So there is no way from a single return stream you can generate a linear equity curve. And if we get that, we know they're going to be curve fit. But what we do when we get an equity curve that has some resemblance of being volatile, which is necessary, we then map it to the market data. So when we have the market data in front of us, we can visually define what these outliers are, and we can circle those outliers in the market data because they are anomalous features that are very obvious to the naked eye. They sit well above what a normal trend is. These are big, anomalous events. Now, dependent on the cleanliness of that outlier is going to determine whether we are able to catch them effectively with our models. So if we see a nice clean outlier, we know there must be some representation in that equity curve that we have caught that. If we don't get a big step up in our equity curve when we can clearly see a lovely outlier, we know that there's a fault in our backtesting. Either our models aren't targeting that particular aspect of the outlier, or our models are targeting noise as opposed to the signals in the noise. So during periods where we clearly can visually see in the data through the outliers that we should be performing, we would want to see that performance represented in our equity curve. But then in other periods, if we see an improving equity curve in a clearly sideways congesting market that offers no significant trending opportunities, if we see improvement in our equity curve, that's suspect. That tells us that the model is dodgy. So we'll then revisit the model and always do this mapping to market. That's one stage in our process. The other stage in our process is that we hit our models, our trend following models, with as much data as we can get our hands on. So we apply what we call an extensive multi-market test. So the philosophy of our models is that our models are capturing an outlier. We can't predict whether the outliers exist. They could be existing in any market data. So that's inconsequential to our models. As provided our models can catch those outliers, that's good. What we do focus on is what is the risk? What is the adverse risk from these stagnating environments or environments that are not positive to our trend following models? There must be times where we get significant drawdowns. We want to see that. We want to test our models in those environments. If we find that our drawdowns get too extreme, we know we've got to do something about that. That is a clear sign that history has said that there's been a regime which our models, supposedly cutting losses short and letting profits run, have deteriorated with a significant drawdown increase, and the drawdown has been a rapid drawdown. When we get that rapid drawdown in our equity curve, we know something's going wrong. We should not be getting a rapid decline in our drawdown. We should be getting maybe a slow decline in our drawdown. But if we're getting a rapid decline, that tells us something's wrong. We're either over-leveraged or our systems are maybe sort of getting continuously whipsawed because they're too narrow in configuration, too short-term in nature, dealing with noise. So these methods of extensive testing across multi-markets or data we generate ourselves or historic data over 30, 40 years, they're just means to assess the possible risk weaknesses that lie in our models. If we can clean up that risk weakness, and we know that our models can catch an outlier because of their open-ended nature, and we've seen that in our mapping to market phase, then we can do a big tick and say, good chance it's not curve fit. We can never remove being overly curve fit, but we can certainly reduce it to as much as we possibly can. I would suggest that everyone that does a backtest is always overly curve fit. I know that people say, well, you should have a lovely back test, and then when you walk forward, you should have a projection that continues on with that nice ascending linear equity curve. Well, that's a story associated with convergence. We don't find that. If we find that we have a backtest result and an equity curve, we must expect we will underperform that. But as you say, in the future, our drawdowns are much more extreme than we ever experience in our history, because of the multiple many paths that exist in the future is always going to test new regimes we've never seen in the past. So that maximum drawdown is always ahead of us. So therefore, in addition to our back test, we can come in with a principle that says, all right, let's cut our risk in half because we know our drawdowns are going to be double in the future. So there are all of these different things we can do in our processes that address what you're talking about.
So just a couple of comments and questions. I'm intrigued by when you say, if we find a drawdown we don't like, we can clean it up. I mean, what do you mean clean it up?
So what I mean there is we can use measures that assess the rapidity of the descent in a drawdown. This is where you'll be familiar with I know you are, Niels, with the serenity ratio. The serenity ratio is a risk-adjusted metric that not only looks at the extremity of the drawdown, it looks at the path of that drawdown. We look at the path of drawdown. So if you could imagine, let's compare some. We have a trend-following model. We see that it has a drawdown. We see that the drawdown is a slow build into a drawdown. We know, therefore, or have confidence over a 30-year time frame, we see that these drawdowns are not these rapid, massive drawdowns. That's, to us, suggesting there's too much leverage in the model, and their drawdowns are getting exacerbated. And when you exacerbate your drawdown, you reduce the impact of the compounding benefit that you can get out of your equity curve. So those funds that have these rapid, big drawdowns, we suspect that it's through excessive leverage, which you want to reduce. So that's a position sizing, possibly a position sizing problem you need to check. You can then rerun your back tests and see with a reduced position size whether the actual profile of that drawdown changes with reduced position sizing. And you'll find it will, because there is not a linear relationship between position size and drawdown. You'll find that as you reduce your reduce your position size, you can actually shallow out your drawdown. It doesn't take the same degree of accelerated progression down into the drawdown.
Now, I'm sure you are much more into the weeds of all of this, so I'm just using my my simple common sense and from what I observe. And when I look at trend following returns, and I look at drawdowns, I think of drawdowns as they can happen in two very different ways. You can, as you rightly say, you can have these long, slow drawdowns, typically when there are no trends and you get stopped in, you get stopped out, and that's kind of the slow bleed. But we've always had the risk of the reversal drawdowns, which are by nature, quicker, and can go quite deep, as deep as any other drawdown, I guess. So the way I think about this is that, okay, so if we're getting a big, quick drawdown, the ones that you say, oh, let's figure out what's going on and let's clean it up, I'm not so sure that doing that is the right thing. It depends, let's put it that way, because if you think about February of 2018, if you think about, to some extent, February 2020, but certainly the February 2018 was a very quick and incredibly deep and painful drawdown for trend followers because we had massive reversals in all sectors at all times. So to me, the question becomes, okay, can I do anything about it? And you might say, yeah, we can do this, that, and the other. But then the question that really becomes, do I want to do anything about it? Because these type of drawdowns happen so infrequently. And this is the question we get from clients from time to time when they go through one of these drawdowns and they are painful. We understand that. And they say to us, can't you do something to avoid this in the future? And we say, yeah, absolutely. But we're not going to do it because it's going to hurt our long-term performance. And we're addressing an issue that happens maybe 1% of the time. So to me, it's very hard to just say, oh, just because I see a big, deep drawdown, quick drawdown, that's a really bad thing. I think it comes with the territory, and it comes with the fact that we say we have no idea what the market action will be in the future, and therefore we must expect. And also the other thing, by the way, Rich. So when you and I started in this industry, markets were much more non-correlated. I wouldn't use that word. Let's put it independent. For example, if Japan was having a great time in their economy, the US could be in a recession, or Europe could be somewhere in the middle. Meaning, when you look at your equity portfolio, they were really doing different things. If you look at your fixed income portfolio, they were doing different things. Currencies were maybe much more free and loose and all of that. Nowadays, we have to recognize that the economic powers of the world are highly, highly synchronized. So the returns we get from these sectors today, or let's put it that way, the price moves we get in these financial sectors today are very different from what we used to get. So I can imagine that there's a higher probability today to get a quick reversal. And we see that. We see it with the naked eye, that when we have a big issue in the US, all the other countries of the world follow suit. All the equities sell off, all the bonds, they do their thing, but it's so highly correlated, which is, of course, why we and the most people who come on the podcast argues for diversification, not just within the portfolio of trend following, meaning we want the commodities, we love the commodities, they're the least correlated to all the other markets we trade, but of course also that trend following should be part of a portfolio that consists of assets or strategies to which it doesn't have much correlation. So I guess my point is, we could go back to the 1990s market conditions. We don't know. We could stay with the way things are today. But either way, we should expect that from time to time, drawdowns will be sharp, deep, quick, whatever. Sometimes they'll be long, bleeding, etc., etc. And I think the backtest should show both. And as long as it doesn't, overall spoils the picture and that you can't live with it, it's okay. I wouldn't clean it up just because of that reason. I actually would expect you have a bit of both.
I like this topic, Niels, and we're not going to get to these other topics we're meant to be talking about today.
No, I know.
I like this sort of topic because I would say that yes, we can do something about them, and this is a bit of an evolution that I've seen in trend following, and this is towards this notion that we're not getting the same degree of diversification benefit across markets these days. Because with all of this fiat money in the system from central bank intervention, all of this floating money rests in all of these financial assets. So all of these commodities, currencies, bonds, everything, they're all basically being lifted up by this fiat money, and they're all becoming fairly highly correlated. And so we saw in March 2020 this massive positive correlation where everything went down together. But this is where I think the likes of Bill Eckhart and things like that are sort of evolving towards with this system diversification. Because when I, for instance, see a drawdown that is accelerating, I can do something about it. I can swap out my systems that are producing. So let's say I've got a fixed universe of markets that produce this equity curve, and I see this weakness in the equity curve. So I believe as a risk manager, I'm behoved to address every risk weakness I see in my system. And if I see this fast accelerating drawdown, I believe that I should be doing something about it. I can't do anything about my outliers. I must let profits run, but I can do something about my risk. And what I'll do is I will start playing around with my system diversification to see if that changes that profile. So by blasting it with this intense amount of market data, I can see through swapping in and out more diversified systems, those that are giving me what I call these co-integration benefits that reduce this impact of correlation. Now, it's inevitably correlation that's causing this fast accelerating drawdown because everything is suddenly positively correlated. And whilst we're cutting losses short with all of our trades, when they're positively correlated, all of our trades are we're getting massive numbers of these small hits and our drawdown decreases. However, the system diversification in that, and I know you do this with your models, probably more you and me, more than say what Jerry does or what Moritz does. I'm not quite sure, but I'd say we do play excessively with this system diversification idea, which actually does allow us to manage those risk weaknesses in our equity curve. So that's what I'd be focusing on if I did see that risk weakness in my backtest.
Yeah, okay. So I completely agree that I think it is a good idea to, I like the classical way of doing trend following. I think there's absolutely nothing wrong with that. But as you rightly point out, in the Top Traders trend following model, there is definitely different types of trend following strategies. And I've explained that in episode 120, 121 of the Systematic Investor series, and went into some details and what the thinking was and so on and so forth. So I do think that makes perfect sense. You could say that the idea that we had back then was really to say, okay, if you're going to hire 5 or 6 different traders to trade your money, they all had to be rules-based, but they don't have to be all the same. So how would you do that? And that's essentially what we've done. And it does help, I think, or at least it makes a lot of common sense to do it. But I don't think if you can avoid the sharp drawdowns, because at some point, if the trend is up, all the models are going to be long. If the trend is down, all the models are going to be short. And if you have a big reversal from that, there's no way around it. You're going to have it. So I would never do something to try and fix the problem, if you know what I mean. I need to get to a level where I think, okay, I'm comfortable with that and I fully understand why it happens. But I don't think you can fix the problem completely. And I don't think we should, because we know the future is going to be different from the past. So I think it's more important that you find things that you actually believe in saying, yeah, if I have a little bit of this kind of short-term reaction type of models over here, I have these long-term trend following models that are hunting for these outliers, but they also have a big neutral zone where they don't get whipped around too much. And then you may have something kind of in between. And in my case, and some people will say, well, that's definitely wrong to do so. But in my case, I recognize the fact that we are better as trend followers to capture profits from long-sided trades, maybe because the upside is infinite, while the downside of a market, maybe with the exception of oil that actually did go negative last year, but usually it can only go to zero. So we know that there's some kind of limit to that. Also, and this has been my observation from starting out as a trader, is that it takes longer to form a high than it takes to form a low. And therefore, I think we have more time to capture long-sided trades. All of that, whatever you believe in, it doesn't really matter. But for me, it made logical sense to put together this team of models. And it's not to say that the end result is vastly different from other types of trend following strategies or programs, but it's something that at least I'm comfortable with. But as I said again, it has all the hallmarks of the same quote-unquote weaknesses than any other trend following model will have. But I don't see them as a weakness. I see them as this is what it has to look like. For you to hunt for the outliers, you need to accept that there is a price for that, and the price is quote-unquote drawdowns, or being in a drawdown for most of the time, which, by the way, is not unusual with many equities. I once saw an article, and I'm pretty sure that it was, I can't remember, it was analyzing Amazon or whatever it was, but it was some kind of stock that had gone up, hugely. But actually, when you looked at the daily data, it showed that 90% of the time, it's not at its all-time high, meaning just like a trend follower, you're in some kind of a drawdown 90% of the time, but still those 10% where you make new all-time highs ended up giving you fantastic long-term returns, just like trend following has done. So anyways, maybe to round it up, because I think you're right. I think let's not jump into any more things. We've got plenty of things to for people to think about with today's topic. But if we were to think about maybe some key stepping stones in a backtest process, for example, maybe the first thing you want to do is you want to think about what is the big idea, what is the thing you want to test. Maybe that's kind of your checklist number 1 point. Then you also have to define your framework. What are the parameters? What are the slippage? What is the data period you want to test, et cetera, et cetera. I mean, if we go through that, do you have certain things you do in a certain order? Do you have certain things you always want to make sure that you do in a backtest when you create your checklist or whatever we call it?
Yes. So what I do is the first thing I do before I do any testing is I use a logic design principle to say, what edge is it I'm attempting to target in this market? So I'm not sort of designing systems that are just sort of data mined that seem to work without having a logical reason. So I apply a logical design principle first to say, right, if I'm doing trend following, and I always do trend following, just so we're all clear, then what I'll do is I'll say, in that design principle, these are the golden rules that must be obeyed. Cut losses short, let profits run, initial stop, trailing stop, no profit target, ATR-based methodology. And then I say, right, they're the golden rules that must be obeyed by every single trend following system I apply. But now let's develop a multiple different array of breakout systems and different forms of trend following system to give me entry diversification and also allow me to target different aspects of the outlier with their different initial stops, trailing stops, and entry condition. So I might have, five models, one of which or two of which are breakout models, or 10 models, 4 of which are breakout models. And then I say, right, whatever I do out of this entire design principle, I must use a bare minimum of X number of breakout models. I must have that as a particular class of model in my trend following system. And then the balance must be alternative trend following models that gives me diversification. Once that's done, then I commence the backtesting phase or the testing phase. What I then do is say, right, I need to hit these models with as much data as I possibly can, because I'm of the opinion that there are many paths of uncertainty, and that single historic return stream of 40 years I've got is one single path. I need other paths. So I've either got to recreate alternative paths, or I use multi-markets, different markets over that same time frame to then hit those models with as much different data as I can. Once that's achieved, that is my robustness test of the process, what I regard as robustness. Then what I say is, right, all of the models that pass that robustness test, and I use risk-adjusted metrics to identify the successful candidates. I'm not looking at profits. I'm not looking at profit factor. I'm looking at risk-adjusted metrics such as the MAR ratio, which is a compound annual growth rate over the max drawdown. I use that as a basis to say, right, on a pound for pound reward to risk relationship, what is the best ones to use? So that means that I know that they're capturing outliers, but I also know that they're not getting eaten up with the costs of adverse volatility. So then once I've got that robustness phase completed, I then go into, and I know Jerry's not going to like this, but this is where I have an adaptive component, because I'm a firm believer in the need to have some adaptive component in my testing to ensure that my models slowly adapt with the nature of the market. So trends have changed since the 1970s. And I'm saying that, well, outliers actually haven't changed, but what has changed is the noise and mean reversion that exists in the market from increased participation in the market from all of these different behaviours. Trends are harder to catch these days than they were with shorter-term models. Now we've got to step out with longer models. Now, an adaptive process would pick that up rather than a discretionary, oh, what's going wrong with my models? I need to change something. Oh, let's step out into the longer timeframes. I'm using an adaptive empirical process to say this is what the data is telling me, so I must do something about it. I'm not making any form of haphazard judgment that might be wrong or might be biased, in my opinion. So I'm using this, what I call a recency phase, to look at the last 10-year window. It's a rolling window for all of my models, which then says, right, out of those last 10 years, have there been any outliers in those periods? If I can identify outliers in those periods, then I want my models to be able to catch them. And this is where my data mining process over extensive data sets, but over a 10-year horizon, slowly adapts the models so they become from short-term to long-term in nature. But it's not a quick adaptation. It's one where my collection of return streams in my portfolio that I get at the end have passed two things. Robustness is an essential requirement, and it's a contingent statement, and recency. So there's robustness and adaptivity in my models. If they meet both criteria, it's not a robustness or recency. They must just test. All of the ones that pass the robustness tests are then further refined with this and statement to get. Also, they have this adaptive component in them, which shows that they are better addressing trends of today than they were with trends of 1980 or trends of 1970. Provided that's a 10-year rolling window that slowly moves forward, I know that I can keep my portfolios razor sharp. Now, I do this process annually. So at the end of each year that I do this robustness and recency phase, I then totally replace all of my models with what has been generated from the robustness and recency phase with this additional 12 months of data to all of this prior data and method that I've applied. So therefore, this adaptive notion is integrating itself into the data. And I'm finding that now, when I say I replace my models, it's not a rebalancing exercise here. I'm not doing a rebalancing, but let's say at the end of 12 months, I've got 76 current open trades of my models. I let them play out because I let profits run. All I do is I prevent them from taking any further trades. Then I overlay the complete new suite of 12-month models into my program. So I believe that process is what I call keeping my backtest razor sharp, keeping my portfolio razor sharp. It's saying I don't want discretion in my judgment about what's working. I want the data to tell me a story, integrate that into my models, and so that's my process I adopt for my backtest. A bit long-winded, pretty data intensive, but that sort of outlines the process.
No, I like that. And that's something that I can recognize from the place that I work. Not exactly the same way, of course, and when you say you replace the models, I don't know whether you're just saying, well, actually, I allow the models to recalibrate themselves and pick new parameter sets. It's not really new models, it's just different parameters. At least that's what we do on our side. We allow the models to kind of reconfirm parameter based on, as you say, more recent data rather than data that may not really be that applicable anymore. So I think that kind of makes sense. But I will also say, I can also see that it works perfectly fine to stay with fixed set of parameters as long as you have many combinations to begin with. I don't know whether you can say one is better than the other. It's different. And again, it's down to your personal preference, what you do and what kind of complexity you want to have in your model. And how essentially how automated you can create these things, because some of this stuff sounds complicated, but nowadays it can all be done pretty much with a click of a button. So yeah, no, I like that idea. One thing that's, again, people need to consider when they do backtesting, I think it's worth maybe not necessarily throw everything into the same test. I mean, you might want to see if you're using, especially if you're using things like filtering, you might want to do the test filter by filter to see what the actual impact is on a filter. And if it isn't a big impact, I would say maybe it's better to leave it out, because what you want to put into your system at the end of the day is something that has a significant benefit to it. And also it goes with hand in hand with what we're trying to do in general, and that is get rid of the stuff that is not necessary, and therefore keeping it simple. As Jerry would say, one entry, one exit, one stop. Okay, that's the bare minimum. Maybe there's one or two extra bells and whistles you want to put on. But in general, that's certainly what we prefer to do. And then obviously, once you've done that and you've used all your in-sample data and testing, you want to use data that the model hasn't seen, see what it does, what it looks like. Ideally, you want to then, as I was saying, I've been doing now for 8 years, and that is you want to run it as a live forward test. You want to see that it continues to work as you would expect it to do. Probably people don't want to do that for 8 years, but at least for some period of time, I think you should do it, before you switch to a real market environment with real money and so on and so forth. And then, of course, when you do switch, as we were talking about initially in our conversation today, when we were answering the question from Louis, when you do switch to a live environment with real money, start small. There's no rush. This is a 50-year game for those of you who are clever enough to start early. And for some, it's a 10-year game. But,
too late for me, Niels.
Well, life expectancy, Rich, is going to increase dramatically, I hear. No. But yeah, I mean, of course, one needs to take that into account as well. But this is, of course, why, and I think this is what we're going to be talking about also next time, is the wonders of compound effect. I mean, if you can do trend following for 50 years, like Don has almost done 47 years and still going, I mean, the compound effect is absolutely tremendous. Same with Jerry's long-term track record. It's absolutely fantastic, and it's impossible to beat, I think, really by any other strategy. So anyways, let's leave that for now. I also think we're going to talk about things like skew probably next time, and that's another interesting topic, and the role it plays. Let me quickly run through a couple of performance numbers. My trend barometer actually, even though it was a strong week for us, I noticed that the trend barometer weakened a little bit further. It closed at 37, which is actually kind of a weak level, even though when I look at the performance data, it was positive. So interesting divergence, let's put it that way. But I did note that in terms of the trend following indices, they are still down for the month, down 53 basis points for BTOP 50. This is as of Thursday before the everything rally that happened yesterday. So maybe the numbers are a little bit better by close of business yesterday. But as of Thursday, the BTOP 50 was up 6.89% for the year. SocGen CTA index down 1.02% for the month, up 5.73% for the year. SocGen Trend Index down 51 basis points, up 7.47% for the year. And the SocGen Short-Term Traders Index down 1.12%, up 41 basis points for the year. Of course, we know new record in many equities. That also has helped MSCI World, up 2.1% for the year. For the month, up 16.49% for the year. Hard to keep up with. The bonds, although they have come off this month, down 21 basis points so far. On that note, I think we're going to wrap up this conversation. I mean, Rich and I could have gone on for a long time because it is such a fascinating topic. So, I'm sure we'll come back to this as well as with some of the other people on the podcast, of course. We'll hear it'll be interesting to see what their thoughts are on this. Moritz is the first one to give his thoughts. He's back next week. We will be recording a day later next weekend due to some scheduling. So expect the podcast to come out Monday, I would say. As I also mentioned earlier, we would love to receive a few more rating and reviews, not just a few, actually quite a lot more rating and reviews, because it really helps. It makes the algorithm propose the podcast to new listeners. And as usual, you should send your questions to us, info@toptradersunplugged.com. We do our best to bring them up on the following recording. And it makes it more fun, I think, when we have questions from you, because it helps us, as I mentioned, figure out what really is important to you. And I think it's fair to say that we try to make it a listener-driven podcast. So from Rich and me, thanks ever so much for listening. We look forward to being back with you next week. Until that time, take care of yourself and take care of each other.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.